All right, we're getting ready to start on Module 15 on page 27 of the outline, and going to talk about taxation. At this point, we need to make a couple of observations. The first is that this is not the CPA exam, okay? In fact, if there are tax questions, you are very well advised to tell your clients to consult their own tax advisor, because unless you are a CPA, you're just not qualified to give tax advice. But you do need to have a good working knowledge of what taxes are, how they work, different taxation vehicles that people are going to face, how to minimize those taxes, etc. But like I say, it's not the CPA exam, and so just getting about that deep into something that's very, very deep is enough for our purposes. Okay. So anyway, the second thing is that we, at this point of the outline, we start to get to where we circle back around we kind of just kiss little concepts here and there, and now they come back in and we look in a little bit more depth into those. So some of these things we'll revisit and talk about. That's one of the reasons why it's really important when you're watching these videos to go back and pick up and watch the whole thing, and really does help to watch them sequentially. Because there are certain things that we'll talk about in Module 7 that then we'll pick up in Module 16 again. And we'll lay that foundation in Module 7 and then come back and pick it up later on and just elaborate on it later on. So we've kind of hit that point where we're going to do a little bit of circling back. But that's okay, because we need to see from a different perspective on a lot of these things. So anyway, one last thing let me throw in before we dive in, and that is that we really do appreciate you supporting our sponsors. Again, I've said it over and over again, but it's very true. Everyone on this site has one goal, and that's your success. Everybody wants to partner in your success. And so, click those links, go and see those folks and talk to them. Make notes about what they've got. Get some literature, and because everyone wants you to succeed. There's nobody on that site that's going to try to sell you a condo in Florida or something like that. All wanting to help you succeed. All right. So anyway, let's go ahead then and talk about the taxation, different types of income, and some of the surprise tax terminology. Those terms are very important, whether we're talking about the first of the outline or the last. Okay. So ordinary income is the income that's taxed at regular income tax rates, and regular income tax rates are progressive rates. Therefore, it's called a progressive tax. Now, a progressive tax in general is one where the rates, the percentages, go up as your income goes up. So income tax is the classic case of a progressive tax. The opposite of a progressive tax is a regressive tax, sales tax. Okay? I don't care what your income is. When you spend $1 in Tulsa, Oklahoma, you're going to pay X percent in sales tax. It's just the way the world works. They don't ask you how much you make. Okay, well that's how much sales tax you pay. So that's a regressive tax, an excellent example of those. A flat tax would actually be a regressive tax. Because a flat tax, it doesn't matter how much you make, you'd pay 9% whatever. So progressive taxes, they're indexed to your income, the rates are. But regressive taxes, regardless of your income, you're going to pay the same. There may be some other variable. I mean, how much is a bag of groceries worth? If it's $20 worth of groceries, you're going to pay tax on $20. If it's $50, you're going to pay it on $50. But it's still going to be the same percentage, regardless of how much money you make. Okay, so anyway, that's a progressive tax. Ordinary income tax is wages earned, okay, earned income, and portfolio income are both included in that. Withdrawals from retirement plans, withdrawals from annuities. In fact, the taxable portion of those, withdrawals from life insurance policies also. They're all taxed at ordinary income rates. Now, some of those will have penalties as well, but that's why you figure out how old the guy is when you see that in the question. All right, then earned income is income that you receive from a trade or profession. So you're actually exchanging what you can do with your hands or what you know in your mind, whatever it is that you do, the function you perform for money, and that's your earned income. Portfolio income, though, over on the top of page 28, that includes dividends from common and preferred stocks or mutual funds. Now, this is where we circle back around. Mutual funds, remember, can only issue out to shareholders common stock, and stock always pays dividends. Now, with regard to mutual funds, you have that subchapter M of the IRS code that allows for the conduit treatment of those distributions, but they are in fact dividends. It's just that they can be tax-free if they're from municipal bonds, what have you, okay? And they're taxed at favorable capital gains rate. They are not capital gains. Dividends and capital gains are different. They, in fact, for many years, it's been coincidental that they've shared the same rate. Is that subject to change? Absolutely. In fact, there are rumblings in Washington, D.C. all the time, okay, about changing those rates. So I've got 15% on the outline, but you check it out in case it's changed, because that, what do we call that? Legislative risk, right? So anyway, and is it going to be retroactive? Not retroactive, but people going to be grandfathered in? Probably not. Probably not. Okay, if it does change. All right, so but tax dividends, like I say, are taxed at that favorable capital gains rate, assuming that they're qualifying dividends. But again, that's way too deep. This is not the accounting exam. Interest from bonds or bond funds. Okay, bond funds, again, it's kind of a misnomer because it's actually going to be, out of a fund, it's actually going to be a dividend, but the bonds themselves will pay interest. Corporate bonds will be fully taxable, but treasury interest, again, whether you own the treasury directly or it comes through the conduit of a mutual fund, that's going to be state income tax free. Municipal bonds, okay, agencies including Ginnie Mae's, let's talk about those, generally going to be fully taxable. And then municipal bonds are federally tax-free, and we talked about how an in-state buyer of an in-state bond will have that state's income tax-free. That's why they'll break it down at the end of the year on a fund. X% of our money came from your state, therefore X% of your income, your dividend income, is going to be state income tax-free. Capital gains, short-term gains, treated as ordinary income, just regular income tax rate. Long-term gains, though, have a maximum tax rate at this point in time of 15%. And long-term is defined as a year and a day. Okay? So now, be sure to keep in mind, there's very few tricky things on the test. I mean, they really don't try to trick you. But, you know, the thing is that they'll say that the trade was done on June the 30th, and one of the answer choices will be that it turns long-term on June the 31st of the following year. There is no June 31st. Okay, so just make sure that you're aware of that. So anyway, but that's that's one of the things to keep in mind, that there may be just a little bit of a tricky answer. Okay, so trade date is used to calculate the holding period. 1 year and 1 day is required. On that first day after a year, it turns long-term. Capital losses, pretty good chance of seeing something on this. Here's what you do with capital losses, whether long-term or short-term, okay? First of all, what you do is you start out, I had capital losses of $22,000 last year. Wow, crummy year, okay? It wasn't all bad. First thing I do is I offset my capital gains. Well, I did have $7,000 of capital gains, whether short-term or long-term, don't care, they're going to be offset, okay? So there's $7,000. That leaves me with $15,000 of a net capital loss. Wouldn't it be nice if we could go over here to our 1040 and we have this much income minus $15,000? Wouldn't that be nice? Yeah, the IRS is nice, they're not that nice. They will allow us to take off $3,000 though and put it up here and offset ordinary income. So there's an ordinary income offset. That leaves us $12,000, which is a capital loss carry forward. And the next year we do exactly the same thing. Okay? So the next year, we start out, we don't have any capital losses, but we start out with a $12,000 capital loss carry forward. We have $7,000 again in capital gains. Now we have a $5,000 net capital loss. Well, we can only use $3,000 to offset ordinary income. So that leaves us a $2,000 capital loss carry forward. All factors being constant, we'll use it up next year. If we don't, okay, we have additional capital losses that add to that. We can carry that forward as long as we need to. Okay? So anyway, that's capital gains, capital losses. Mutual fund share identification. We assume the IRS is going to do the things that are best for the IRS. And so what's best for the IRS, if you assume that over the long haul, markets are going to go up, which is reasonably reasonable assumption, then what's going to happen is, if my cost is here, but my value is here, then if I've got multiple purchase points along along the way, then it's best for the IRS. It'll maximize the tax I pay to use those first, those next, etc. So you're going to use first in, first out if you don't specify anything. What you could do is that you could say, no, I made a purchase right here and I want it for some odd reason to use this one right here in the middle. You can do that. Here's the case where you have specific share identification. The guy, actually, what has happened, it wasn't like this. It actually went like so, and what he wants to do, because he's got a large capital gain, he wants to maximize that capital loss. So he's going to sell the shares that he bought here, and here, and here, and here. Oh, excuse me, going to do it the other way. Let's try that again. He's going to sell the shares that he sold here, and here. Maybe it's gone down a little bit, okay? In fact, let's bring it on down like so, and it'll make more sense. And then here, and so those three will actually give him some capital losses. Sell those shares too, those four. Because see, right now, anything that's up above that line is going to give him a capital loss. So he can specify shares that he bought there at the peaks and maximize his loss to offset his gain. Defer the taxation on the ones that he has the big gains on. So you can have a specific share identification as well. Or what you can do is that you can say, well, I'm going to be in a systematic investment program, and I just want to figure this out once. So here's how many shares I got, and here's how much I paid for them, and the one divided by the other, there's my average cost. Once you start that, though, you're locked into it. Can't change your mind later on, okay? Because you have applied that average cost to everything you own, and it's like I say, it's just cast in stone there. Now, wash sales. Good possibility of seeing a question on wash sales. Here's the deal. It's not illegal or anything like that. It's just that basically I buy something. Here's my timeline. I buy something, it goes down. I want to take a capital loss on it. So I sell it right here. I sell it at a loss. Now the thing is, the IRS doesn't mind us taking losses as long as we're at risk. So what is at risk? Being out of it for 30 days. The thing could take off like a son of a gun and we would be off the rocket. So if we wait 30 days, then here we're going to be okay. We're going to be able to take that loss and claim it on this year's taxes. But if we don't wait the 30 days, then what happens is that loss is disallowed. It doesn't go away. What it does, though, is that it adds back into the cost basis of our new stuff. Now, I'm going to do some kind of silly stuff here, but it gets the idea across, okay? We bought something at $75,000, and all of a sudden we find it's $50,000, so we sell it right here. Okay? That gives us a $25,000 capital loss. Okay? I guess I should have done those backwards, but you guys get the idea. Right here, we come right back in and repurchase it. That's not 30 days by any stretch of the imagination. So this loss is disallowed, but the thing about it is, from here to here, this is just like 2 seconds. Price hasn't changed. So what are we doing? We're buying it back in at $5,000. Our loss, though, is disallowed. What we do, though, is we add it back into the cost of our new stuff. What makes the cost of our new stuff? $75,000. Voila, it's a wash. So that's why it's called a wash sale. So we get smart. We say, you know what I'm going to do? I'm going to double up on the stuff. And that way I'll never have to buy back what I sold. No. IRS figures that one out. There are no back doors in the industry, okay? So you got 30 days here, you got 30 days there. You have a 61-day total window. So if you double up here, so you said, you know what? I'm going to get real clever. I'm not even going to buy the stock back. I'm going to buy a convertible bond or a convertible preferred. I'm going to buy a call option. I'm going to buy a right or a warrant, something. No. If there's a string between what you're selling and what you're buying, then the one is the same as the other. So if I can turn this into that, then this and that are exactly the same thing. So substantially identical securities are included in that wash sale restriction. Okay, so gift tax is paid by the gift. No one, well actually you can. I can force you to give me a gift. There's a word for that though. Extortion. But assuming that I'm not going to be using extortion, you would have to decide to give me a gift. People live with the consequences of their own decisions. That's the way life works. So there's a limit, a statutory limit to how much you can give me without incurring gift tax. Now, since I can't force you to give me a gift, no matter how much you give to me, it's going to be tax-free. I mean, I didn't earn it. My portfolio didn't produce it. It just showed up on my doorstep. But like I say, if it's over a gift limit, then you're going to wind up paying some gift tax. All right? And then, like I say, it's income tax-free, though, to the recipient. Donations, when I give something to charity, 501c3 organization, then I'm going to deduct that at the current market value. Estate tax, it's a tax on the value of everything you own. I mean, even the dog is included in your estate. Although I've had some dogs that probably would have been a negative value, but that's beside the point, okay? There's a statutory exclusion. And so anything over that statutory exclusion is subject to estate tax. But no tax if you've got a married couple, no tax is due at the first spouse's death. It's at the second spouse's death that the tax is actually going to be due. And then heirs will get a stepped up cost basis. In other words, Bob bought something at $5 a share. It's now worth $50 a share and he dies. He leaves it to his nephew Billy. Billy's cost basis is $50 because on the date of Bob's death, it was worth $50. Now, contrast that to what happens with a gift. If Bob had bought it at $5, it's now worth $50, and he says, here you go, Billy, I want you to have this. Have you ever given somebody a gift and forgotten to take off the price tag? Oh man, isn't that embarrassing? You do that every single time with securities. So Billy says, wow, thanks, Uncle Bob, I really need the money. What am I going to use for my cost basis? And he looks over on the back and goes, oh man, there's a sale, there's a price tag on there, $5 a share. Okay. So if he sells it immediately, he's going to have a $45 capital gain on the thing. But if Bob dies, then he's got that stepped up basis of $50. He sells it at $50, he has no gain or loss. Okay? And again, it's not the accounting test, so there are other rules that accountants need to know. That's plenty good for us. All right, then the cost basis. One of the things that you can do with cost basis is you can say, how many after-tax dollars do I have in this thing? Okay, and so doing that, this is really where you're going to see something like that, is that you're going to have a question that says that you have a qualified plan or a non-qualified plan, and Bob takes a withdrawal from that plan. Okay, so what you have is that with a qualified plan, non-qualified plan, you have a cost basis. In fact, let's take a withdrawal. Let's take a withdrawal of $20,000. Okay? And we'll just compare the two. Okay? My cost basis, if I put in $100,000 into both of them. Okay, so my cost basis is going to be, in fact, I'll tell you what, let's do this. Let's add variable life into the mix. I take 20,000 out of each of them. My cost basis on the qualified plan is 0 because it's pre-tax money going in. On the non-qualified plan, it's $100,000. On the variable life, it's $100,000. Okay? So my taxable amount is $20,000 because this is in excess of that. But 0 here, I did that exactly backwards. No, I didn't. That's right. That's right. My non-qualified plan, what I'm doing is that, well, the thing is that I need more information here on this one. Because if the value is still, if this is annuity, and the value is still $100,000, then this applies, okay? But we'll change that up in just a little bit, okay? If the value is still $100,000, then I have no tax because I'm just pulling out my principal. And here, because of the fact that I'm first in, first out, this will be 0, but my cost basis will be reduced in both cases down to $80,000. Now, let's add in something into the mix here. Let's say that this is a variable annuity and the current value is $140,000. All right? Now, I still have the same cost basis of $100,000, but because I'm going last in, first out, my taxable amount is $20,000. One thing that I have to do, I have to figure out how old the guy is because there may be that tax penalty. Okay? But like I say, qualified means pre-tax money going in. That means even though I put in $100,000, I have a 0 cost basis in it. Even though it's worth $140,000, still have a 0 cost basis. Non-qualified, they're after-tax dollars going in, therefore I'm going to have a cost basis. Okay? After I get through, if this was the case only, that it was still worth $100,000, then I'd reduce my cost basis. But this being the case where it's worth $140,000, I still have the $100,000 cost basis. I still withdraw $20,000. It'd still be taxable before it starts to reduce my cost basis. I have to actually eat into my original principal to reduce that cost basis. Okay, so let's see. So there's our cost basis over on bottom of 28. Up at the top of page 29, the kiddie tax. I haven't really heard too much about questions on the kiddie tax on this test, but basically if a minor's unearned income is above a statutory limit, then the tax on the excess above that is at the parent's rate. All right, back when we had just outrageous unearned income tax rates, like 70%, what folks would do is that they would shovel so much stuff into Junior's UGMA account that it was ridiculous. And so they said, well, you know, you're using this as tax evasion. And so that's where the kiddie tax came from. Then taxation of mutual funds. If it's a regulated investment company, and we talked about this again, subchapter M of the IRS code allows for that conduit treatment. Then basically what happens, there's no tax to the fund on distributed earnings as long as they distribute a minimum of 90%. Real world, they're going to distribute 100%. This is test world. So watch out for that partial distribution above 90%. That's the only way you can structure that question to see if you know the concept. If they distribute 95, they'll pay tax on the 5%. All right. So anyway, but if they distribute 100, then they're not going to pay any tax at all on those investment earnings. The shareholder is going to have the full responsibility. Distributions are taxable to investors, whether it's reinvested, whether you take it as cash, or you take part in, you know, the earnings in cash and the capital gains reinvest. Doesn't really matter. It's all going to be taxable. Because what the IRS says, that even though it's only for a nanosecond, the money actually, if you slow it way, way down, comes out of the fund, goes into your hand, you touch it, you put your fingertips on it, and then it rolls back around, goes back into the fund in the back door. Okay, well that nanosecond that your finger touches it is enough to make it taxable. All right, and then finally, or excuse me, the fund serves as a conduit. We talked about that. That's where we can get that tax-free income. Even though they're dividends, we'll get that tax-free income out of the municipal bond fund, long-term out of a long-term capital gain. And by the way, that's another thing that we need to keep in mind, is that if a fund distributes long-term capital gains, which basically is all they distribute. I bought the fund 3 days ago, and it distributes a long-term capital gain. It's long-term to me. Because remember, that pipe, that conduit, it's not a magic pipe. You put green wire in, green wire comes out the other side. It doesn't get any stripes on it or anything like that. And so if it's long-term capital gain going in, it's long-term capital gain going out, regardless of how long I've owned the pipe. So it's long-term to me because that's all the fund distributes. And then exchanges between funds, once again, the IRS says it looks like it just goes straight across. No, you slow it way down. What happens? It comes out of the one fund, and then you reach up and you touch the money midstream. That makes it a taxable event when it comes over here to the new fund. That fingerprint will make that money taxable. So anyway, that's a recap of taxation. And so on the next video then, we'll go into Module 16 with laws and various regulations.